Everyone, thanks for joining us. This is the second video we're doing in a series of videos regarding the Payroll Protection Loan Program. The first video we did was an overview of the application for forgiveness. Today we're going to be covering the interim final rule that was released subsequent to that application. And so let me share my screen so you can see what I'm looking at. So this document is the Interim Final Rule, or IFR. And it's really a document that the SBA and the Treasury released just to clarify questions that were posed or finer points of the law or how they're interpreting the law. And so the first, it's a 26-page document. The first 6 or 7 pages are really just the review of the history of the law, and so I'm not going to go over that. Once you get to page 7, I guess, and this is where you kind of get into the meat of the document. And the way they've structured it is they have a topic, and then there's one or several questions relating to that topic with their answer. The questions came from the general public or the accounting industry, and they put in what were the most commonly asked questions and their interpretation or response to that. And so under the loan forgiveness process, the first question here is, what is the general process to obtain loan forgiveness? And their response is fairly lengthy, but just the abridged version is that you're going to fill out that application that we reviewed in the last video, submit that to your lender, and then your lender has 60 days from the receipt of a completed application to make a determination as to whether or not all or a portion of your loan would be forgiven. And generally speaking, the SBA is going to rely on the lender's determination as to what the forgiveness amount is. But in some cases, they may come in and audit those that application or application for forgiveness. And then in the case of borrowers that receive more than $2 million, they have stated that they will come in and audit those. Next, so that was the only question under that section. So the next section here is payroll costs eligible for loan forgiveness. And the first question is, when must payroll costs be incurred or paid to be eligible for forgiveness? Generally speaking, this hasn't changed since the law was instituted, but they did add an alternative covered period, which is the first day of the first payroll cycle in the covered period. And all that does is allow you to line up your covered period with the payroll cycle, which makes this a little bit easier to administer. The other thing they clarify here is that payroll costs are, they're incurred on the day the employee's pay is earned, and they're considered paid on the day that paychecks are distributed or that the borrower originates the ACH credit transaction. That's important just because things have to be paid inside the covered period and have to be incurred inside the covered period in order to be forgiven. They also point out that if you have employees that aren't performing work but are still on the payroll, then the payroll costs are incurred based on the schedule established by the borrower. So basically, they allow you to make your own schedule as to when things are incurred, but it would typically be the day that the employees would have normally worked had they not been off or furloughed. The next question here is, are salary, wages, or commission payments to furloughed employees, bonuses, or hazard pay during the covered period eligible for loan forgiveness? The answer is yes, which this was probably one of the bigger questions that was sitting out there as to whether or not the SBA was going to allow us to bonus our employees during the covered period and still make that part of the forgiveness amount. And so luckily they came out saying that it will be, and still subject to that $100,000 prorated for the covered period. So you can't just bonus them an unlimited amount. They have to maintain that $15,385 per the 8 weeks or less. Let's see. Are there caps on the amount of loan forgiveness available to owner employees and self-employed individuals? The answer is yes. And originally, this was always the case that owner employees, as well as all employees were going to be capped by the 8/52 of $100,000, which is $15,385. What this document is saying is that on top of that, owners and self-employed individuals will be limited to the lesser of the 100,000 prorated for the covered period, or 2019's compensation prorated for the covered period. This is new as of this document. It wasn't in the law, but this is how the SBA and the Treasury are interpreting this. And so we have to kind of run with what they're saying on this. They lay out a few other things here. So the way they calculate the capped amount for Schedule C filers is it's based on the 2019 net profit. For general partners, it's capped by the amount of their 2019 net earnings from self-employment, which is then reduced by 179 expenses, unreimbursed partnership expenses, and depletion from oil and gas properties. You'll then multiply that by 0.9235 to account for the self-employment tax. The other piece of this that was kind of surprising to me, and is also new to this document, is that no additional forgiveness is going to be provided for retirement or health insurance contributions for self-employed individuals, including Schedule C filers and general partners. This was never stated in anything in the original law or subsequent guidance until now. And again, like I said, it's kind of surprising to me, as it doesn't seem like they're treating Schedule C filers and self-employed general partners the same way they're treating S corporation shareholders. So, if you're an S corp owner, that's different than being a self-employed individual. You're considered an employee of the S corporation at that point. And so for S corporation owners, they're allowing you to take the salary and the employer portion of retirement plan contributions and healthcare contributions. This sentence right here, the wording is a little odd, and so I had to read it a couple times, but it almost makes it sound, and what I thought they meant the first time I read it was that they were going to cap the amount of 2019 compensation at the 2019 compensation, employer retirement plan contributions, and healthcare contributions together at the 2019 amount, or 100,000. After reading it a couple times and doing a little bit more research, I think the interpretation is that they're considering each of those separately. So 2019 employee cash compensation is limited to the 2019 amount. Employer retirement contributions limited to 2019. Healthcare contributions limited to 2019 amount. Again, the wording was just a little confusing, so that's our interpretation of it, though. Section 4 is the non-payroll cost eligible for loan forgiveness. And the question is, when must non-payroll costs be incurred or paid to be eligible for forgiveness? And so generally speaking, we're dealing with the same set of rules as before, but what they added was that costs incurred during the covered period and paid before the next billing date, even if that's after the covered period, are still eligible for forgiveness. Their example is a pretty good one in this case, where if you have a covered period that starts on June 1st, ends July 26th, and you pay May and June electricity bill during that period, and then July on August 10th, which is the next regular date, you can seek loan forgiveness for all 3 of those months, with the July electricity bill having to be prorated up to the end of the covered period. So for July, you'd get May and June in their entirety, and then a portion of July's bill. Next question is, are advance payments of interest on mortgage obligations eligible for loan forgiveness? And the answer is no. That's not a surprise. I always kind of figured that was going to be the case. So reduction in loan forgiveness amount is the next section. And first question is, will a borrower's loan forgiveness be reduced if the borrower laid off or reduced the hours of an employee, then offered to rehire them at the same rate of pay, and the employee refused? The answer is no. They will not have a reduction in forgiveness amount due to that, but you do have to meet certain criteria and take certain actions. And so first you have to have made a good faith written offer to rehire the employee. Written offer is important, and what I would suggest having you do is, if they decline, or whether they decline or accept, having them sign off on whatever they're doing, so that you have some sort of documentation to that fact. The second thing is that the offer was for the same amount of salary or wages and the same number of hours before the separation occurred. What I was originally thinking when they first said that this was going to be how they interpreted this was that you could reduce their pay up to 25% and still have it be forgiven. But what they're saying now is that it's got to be for the same salary or wages as before. The offer has to be rejected by the employee. The borrower has to maintain record that the offer was rejected. And so that gets back to what I was saying here about having something signed by the employee. And then this piece right here is kind of interesting. They are requiring that you inform the applicable state unemployment insurance office. And the reason for that is that if the employee had a valid offer for a job and they declined it, then they're not going to be eligible for unemployment. So the Illinois Department of Employment Security, IDES, has a form specifically for reporting to them whether or not you made an offer to an employee that rejected that. The next question here is, what effect does a reduction in borrower's number of full-time equivalent or FTE employees have on the loan forgiveness? Again, the same same set of rules that we were dealing with before. If you have a reduction in FTEs, whatever that percentage reduction is going to be a percentage reduction in your forgiveness amount. And so if your FTEs drop by 10%, your loan forgiveness amount is going to go down by 10%. What they've added from the original rule is the comparison periods. There was always this first and second period here, but they added the third one, which is any consecutive 12-week period between May 1st and September 15th of 2019. But that's only available to seasonal employers. What does full-time equivalent employee mean? Full-time equivalent employee means that any employee that worked an average of 40 hours or more each week. And as to how you calculate the number of full-time equivalent employees, you take the average number of hours worked divided by 40 and cap it at 1. So you would never have somebody working overtime that would be more than 1 FTE. But if somebody's working 30 hours a week, for example, they would be 0.75 FTE. There was some consideration that the SBA would use a 30-hour work week for this calculation, but they decided not to, and that makes sense. Typically, you would use a 40-hour work week to calculate FTEs for other purposes, so it makes sense that they're using it for this purpose. What effect does a borrower's reduction in employees' salary or wage have on the loan forgiveness? Again, it's the same set of rules that we've been working with. Not much is new here. If you have a reduction of any employee's salary or wage that's more than 25%, you're going to have a reduction in the loan forgiveness for the amount that exceeds 25%. And that's done on an employee by employee basis, not in the aggregate. This one was interesting. This was always a question I had. How should borrowers seeking loan forgiveness account for the reduction based on a reduction in the number of employees relative to reduction relating to salary and wages? So what they're asking here is, if I have a reduction in FTEs, that's going to automatically result in a reduction of wages because the employee is going to be working less hours and making less money. And so how do you handle that? And what they're saying is that the intention was never to doubly penalize anybody. And so the way they're going to handle this is that the salary and wage reduction applies only to the portion of the decline in employees' salary and wages that is not attributable to the FTE reduction. And so in the case where you had an employee that was working 40 hours a week and you reduce them to 20, they're obviously going to be making less money, but there's not going to be a reduction in wage because you're going to have a reduction in FTE. If you had an employee that was working 40 hours a week and you reduce them to 20, and they were also making $20 an hour and you reduce them to 10, then you're going to have a little bit more complex of a calculation, and you have to take into account the amount that was reduced due to the hour reduction, and then any additional amounts would be a reduction in wage or salary. I know we have a few clients that had rate of pay and hour reductions for their employees, but for the most part, I think most people, if they did anything, were reducing just the hours and not changing the rate of pay. And so hopefully most of you won't really have to deal with this wage reduction too much, but you should just be aware that it's out there and it is something you have to at least consider. The next question is, if a borrower restores reductions made to the employee's salary, wages, or FTE employees by no later than June 30th, can you avoid a reduction in his loan forgiveness? The answer is yes, that if you had reductions between February 15th, 2020 and April 26th, 2020, but you restore those reductions by June 30th, you are exempt from the reduction to your forgiveness amount. Next question is, will a borrower's loan forgiveness be reduced if an employee is fired for cause, voluntarily resigns, or voluntarily requests a schedule reduction? The answer is no, that if you have to let somebody go for cause because they were stealing or creating an unsafe work environment, whatever it may be, or they choose to resign or want reduced hours, you are not going to be penalized for that because it's beyond your control. That was another big question that I had from when this law was originally written, that why should you be penalized for something that you really have no control over? This last part here just relates to the documentation requirements. I'm not going to get into the detail. I covered this in the last video, and the only thing I'll say on this is that you really should be keeping good, clean, organized records, because it's going to make your life a lot easier when you go to submit the application to the lenders. Just giving the lender a shoebox full of information is going to make them have to start digging through it all and maybe questioning what you'd given them. Whereas if you give them nice, clean, organized data, it's going to be a lot easier for them to see where you're coming from and see how you arrived at your calculations, making it easier for them to approve the forgiveness amount. The rest of page 23 and through 26 is just administrative stuff that really has nothing to do with the forgiveness calculation or how the loan's administered, so I'm not going to go through that. What I do want to go through is the Paycheck Protection Program Flexibility Act, which was passed by the House of Representatives 417-1, and is now awaiting a vote by the Senate. And so the highlights of this bill are that it reduces the amount of the loan that has to be spent on payroll from 75% to 60%. And that's a result of a lot of businesses pushing that the 75% threshold was too high. They wanted something closer to 50-50. And so the House of Representatives came up with 60-40 as a compromise. It also extends the window that the businesses have to use the funds from 8 weeks to 24 weeks. So that would be a good thing, giving a lot of you extended time to get this money spent, which is really what is causing a lot of people some issues in being able to spend 100% of their money in a way that would have forgiven. It pushes the June 30 deadline to rehire workers back to December 31st. So you have some additional time there, which is nice, and would help reduce the reduction in forgiveness amounts. It provides a little more leeway on loan forgiveness for business owners who couldn't rehire workers or reopen because of safety concerns. And And it extends the time recipients have to repay the loan, and it lets companies that get the loan forgiveness defer payroll taxes as well, which is currently not allowed. So again, this is not law yet. Still has to make it through the Senate and then get signed into law by the president. But it is good to know what's kind of potentially coming down the pipeline. Just everything I've heard, I've actually heard mixed opinions on this. That where some people think that there's enough similarities between what the Senate wants and what the House wants to get this thing through. Some people are saying that it's going to be such a partisan issue that the Senate's going to shoot it down just because it came from the House, essentially. That time will tell as to what happens with that, but it's nice to be aware of what's coming down the pipeline, and we'll keep you apprised as to what ends up happening with that. That's pretty much all I wanted to go over here today. Keep an eye out for some subsequent videos that go into more detail on the calculations of the loan forgiveness amounts. And if you have any questions or concerns or comments, just please reach out to us. You can find our contact information on our website at www.conwaytax.com. And thanks for watching.